Hello again, and this is the beginning of the Elliott Waves forecasting project. You've seen the introduction on the website, and from this moment on, I will try to deliver the recordings. This is the first chapter of the series. The first chapter really is designed to introduce you to the concepts, only basic concepts divided into 3 different subchapters. And this first chapter will actually have approximately 8 recordings. So depending how things are going to move. So it is designed to address the basic concepts of Elliott Waves theory, like what it means with these 5 waves up corrected with 3 waves down. When you ask a trader if he knows something about the Elliott waves theory, he would say that well, 5 waves up corrected with 3 waves down. That's the principle behind this Elliott wave thing. Well, this is very much true. And under this concept, a sequence of 5 waves up is being called an impulsive move, and the sequence of 3 waves down is being called a correction. As simple as that for the Elliott Waves theory, and you might say that this is quite an easy task. Normally they should be 5 waves up. Okay, so you have 5. Let me take this one. Let's make it like this so that we can clearly see. So 5 waves up, like 1, 2, 3, 4. So 5 waves up, okay? Corrected with 3 waves down. 1, 2, 3. Now normally when you are labeling these 5 waves up, so let me just write here 5 waves up. Corrected with 3 waves down. Remember, this is only the first chapter. Only the first chapter of this educational series. I'm going to have 11 chapters and more than 80 recordings. So now just introducing basic concepts to you. So 5 waves up, corrected with 3 waves down. Usually the 5 waves to the upside are being counted with numbers. So something like 1, 2, 3, 4, and 5. And the correction is always being counted with letters, something like A, B, and C. So 1, 2, 3, 4, 5 corrected with A, B, C, and you have 1 move up correcting with 3 waves down. Now this is valid in an uptrend, but it is not necessarily to be only in an uptrend. It's valid also in a downtrend. In a downtrend you have 5 waves down corrected with 3 waves up, and that should translate in something like this. For the first wave, and the second, and the third wave, and the 4th wave, and the 5th wave, and then corrected with an A, and the B, and the C. And this is 5 waves. As you can see, these are 5 waves down, correct? Five waves down, corrected with 3 waves up. And this is still the same move, just it is inverted. It refers to a downward move, and it should be labeled like 1, 2, 3, 4, and 5, and they are corrected by A, B, and C. It is the same concept, the same concept, the same principle, the same 5 waves up, 3 waves down, or in this case 5 waves down and 3 waves down. Now this is the concept behind the Elliott Wave Theory, where things get really complicated is that each of these 1, 2, 3, 4, 5 and A, B, C, so each of these waves are being formed by 5 different, for example, this move for the first wave to the upside is being formed out of 5 different small waves of a smaller degree, also 5 waves to the upside, correctly with 3 waves to the downside here. So 1 and 2 basically can be formed out of this whole structure of a lower degree. So this is the complicated part, as from the fact that each and every wave from the 5 waves is being formed by another sequence of 5 waves up, but from a different degree or a smaller degree. And those 5 smaller waves are being corrected by 3 waves of a smaller degree as well, and so on and so on and so on. For example, if you start on the monthly chart, then 5 waves up on the monthly chart are being composed of a multitude of different subwaves of different degree. So the complexity of the Elliott Waves theory comes exactly from these subdivisions when counting waves. Knowing where to start the count and when to end the count, it's one of the most difficult tasks for traders. What I do love about Elliott Waves theory is that actually it is a sum of different scenarios. I mean, you look at different scenarios, you check the rules for an impulsive move, for example, for a leading diagonal or for an ending diagonal, and if the rules are not respected, then you just eliminate that scenario, and until you are being left with the one that is the proper one. What needs to be done all the time is to check if the rules are respected, and by the moment it is invalidated, then the scenario should just be eliminated. Under this concept of 1, 2, 3, 4, 5 and ABC can be viewed different patterns, for example, within the currency market. One more thing, you have to note that when Ralph Elliott developed this theory, it was addressed for the stock market, not for the currency market. Today, being addressed to the currency market, then more complex forms of it are to be identified. Why? Because the currency market is quite implies quite a volatile environment. You have to think of all these algorithms and high frequency trading that is taking place on aggressive moves when some central banker speaks or something like this. And what I'm trying to say is that you will need to have a trained eye to identify the basic shapes, not only the basic shapes, but also the complex forms that may be encountered on the Elliott Wave theory when dealing with the currency market. Now, also on this Elliott Waves, you might have, for example, if you're looking at a book, there are a lot of books that can be found over the internet, or just go over the Amazon and search Elliott Waves. You see a lot of titles there. So from the textbook, you will see a nice pattern, a nice shape like it is here, 1, 2, 3, 4, 5, and ABC. Well, in reality, market is not really developing that beautiful structure, at least not the currency markets that I'm looking at. So you have to be a little bit more creative, use your imaginations, but nevertheless try all the time to respect the rules. If the rules are not respected, then that move is not the move you are interested in seeing. Now, this was only the first recording from the first subchapter, and starting with the second one, we will try to look at different examples on the market, and what do they mean, how to identify these 5 waves up and 3 waves